Welcome to PSR, People Speaking Rail. I'm your host, Mike Baudendistel. I'm the head of Intermodal Solutions here at FreightWaves, which is the largest media and data company that's focused on freight transportation. If you're wondering where Joanna Marsh is, she's out this week, I think maybe dealing with some combination of how a tree falling on her house and other sort of personal issues. But I think you're in good hands. We'll go through some of what's on the FreightWaves.com website related to railroad industry, and then I'll take you through a few charts from FreightWaves SONAR. And also just want to point out right at the top, in a couple of weeks, we just booked a good guest for Thursday, July 13th. It's going to be Chuck Baker, who is the head of the Short Line Rail Association. So we'll really dig into the issues of impacting the short line. So I hope people can join us for that. So with that, I'll get into taking you a little bit of a tour around the FreightWaves.com website for those articles that are related to the railroad industry. We do publish about 40 or 50 articles a day. It's almost humanly impossible to absorb all the information that's on FreightWaves.com between the videos and the articles, but it's sort of a curated look. We'll take a look at a few railroad articles. I want to bring up this first one, which was a piece written by my colleague Noy Mahoney, who I just saw the other day at our conference in Cleveland. And Noy is writing about railroads moving to create more access between Mexico, Texas, and the U.S. Southeast. And he's talking about a partnership that has been proposed between Canadian Pacific, Kansas City, the newly merged railroad there, and with CSX to create an interchange in Alabama. You see a picture of a rail yard, intermodal rail yard. And so what's basically been proposed is a plan between those two railroads where they're going to leverage a connection by a short line railroad that is in, sort of connects Mississippi and Alabama. Have a chart, a map to that effect. And so if you can see the sort of the white lines, I guess it doesn't stand out too much. That's part of the CPKC now, the part that was formerly the Kansas City Southern, those white lines, largely the north-south corridor, although it does go east-west through Mississippi. And then you look at the yellow lines are CSX's network. And if you can see the graphic close enough, you see there's a gap in between those two networks. I believe that's along I-20, essentially, between Meridian, Mississippi, and Montgomery. There's a lack of a connection there. And so the idea with this partnership is that they're going to leverage the operations of a short line railroad that goes 168 miles called the Meridian and Bigby Railroad. That's one of the many short lines that's owned by Genesee and Wyoming. And the idea is that it's going to give CSX a new option to take traffic in and out of Mexico while also supporting its business in the U.S. Southeast, one of the faster growing portions of the U.S. economy. There's a quote from Keith Creel in that article, who's the CEO of CPKC. And he sort of calls out that this is going to be impact intermodal segment and automotive, among other customer segments. It does seem like intermodal and automotive are going to be the two revenue segments that are potentially be the most positively impacted in terms of railroad traffic by the CPKC merger. And it's sort of worth noting, and Noy brings it up in his article, that this is kind of one of many plans that have been put into place to either grow the intermodal volume or expand services. An article we wrote about the other day was CPKC taking delivery of 1,000 53-foot reefer containers with the idea that's going to contribute to cross-border Mexican freight. That's really sort of a show of confidence in service to have those refrigerated containers. That's been something that's been difficult for some other companies. We did see that the Tiger Cool Express go out of business a week or two ago. And then back in April, the CPKC announced agreements with Schneider National and Knight Swift, so two of the big domestic truckload-based companies that also are heavy into intermodal, using the company's Mexico Midwest Express daily premium intermodal service. And then we've also seen announcements from Canadian National Railway to expand its intermodal service. They've announced partnership with Union Pacific and Ferromex for transcontinental intermodal service. So a lot going on between the U.S. and Mexico border. It really shows that the carriers are expecting those to be growth areas, in addition to the expectation that the Port of Houston is going to continue to be a growth area. We've seen new services rolled out in recent weeks from both Union Pacific and the BNSF for new origin destination pairs from containers coming out of Houston to points westward, such as Salt Lake City, Denver, Fort Worth, et cetera, and those should be contribute to maybe an improved balance in the intermodal networks of those rail lines. So there's a lot that we're reporting about as far as intermodal service goes and additional railroad service. So stay tuned to FreightWaves for that. I'll go on to the next article I want to discuss here, which is the Surface Transportation Board. We know the STB is the executive organization that economically regulates the railroads in Washington, D.C., in lieu of the fact that it's not overseen by the Department of Justice. And this is an article written by my colleague Joanna Marsh. And Joanna is describing this STB order for BNSF Railway to send more coal trains to the Montana mines. And so essentially what happened here is there's a big coal company that's moving coal out of Wyoming for the export markets. It's going from Wyoming to Vancouver, British Columbia, and essentially they said that they weren't able to get that coal to market because the railroads were violating their common carrier obligation by not providing what it considered to be an adequate level of service offering. And so now here we have the Surface Transportation Board ordering the BNSF Railway to send more of this coal in an expedited manner. The name of the coal company is Navajo Transitional Energy Company. Said it couldn't get its coal to the ports. And what's interesting about this is, really before last year, there really had not been a lot of these emergency orders that had been issued, that had been imposed on the railroad. I mean, last year we had Union Pacific being ordered to move animal feed for Foster Farms. So we had that issue. This is really, in a lot of ways, a similar issue here with coal, and it does sort of get to the point of, well, what is actually a common carrier obligation? I mean, essentially, what it says is that the railroads have to provide reasonable service to any shipper that wants to take advantage of that service. It was what the railroads agreed to in exchange for owning all of that land that was gifted to them by the government. But the question is, what is reasonable? And we certainly have difference of opinions on what is reasonable. The BNSF says that, an emergency order should only be used for true emergencies. And in this case, getting coal from this shipper Facilis mine to port was not an emergency. I'm sure it felt like an emergency to that coal company. And BNSF says, well, the common carrier obligation, does allow for some discrepancy in absolute service levels, and that obligation can be met a few different ways. So it does seem like the STB should maybe go back and reevaluate, maybe put a definition on what is the common carrier obligation. I know that's something that the Surface Transportation Board has been considering as one of the many things that they're taking a look at. And so some of the other details here, BNSF is going to have to transport 4.2 million tons of coal to this shipping facility in British Columbia, and an additional 1 million tons of coal as train crews and train sets become available later this year. That translates to about 23 trains per month. It's also worth pointing out that this was a split decision. And so of the 5 members, the 3 members that you would think of being is a little bit more aligned with the Democratic Party or shippers' interests voted in favor of the coal shipper. And then the 2 dissenters were Patrick Fuchs and Michelle Schultz. And they had concerns about, well, is this going to is this the sort of the right precedent to set? You can go back in the article and see some of the detail, or you can just go to the source material, which is fairly reasonable. I think about 40-page document, reasonable in terms of length for a government document, at least. That's on this STB website. I'll move on to the third article I want to talk about today, and this is one that Cowen, brokerage firm, thinks that reciprocal switching could hit railroad stocks. This is another article that Joanna Marsh wrote up, sort of one of the research reports that hit her desk that sort of caught her attention. Jason Seidel of Cowen, talking about his expectations after interviewing Marty Oberman, the chairman of the U.S. Surface Transportation Board, and that agency says expects to make a decision on approving the reciprocal switching sometime later this year, and so that could potentially be a really big deal. That reciprocal switching is a way to enhance competition on the railroad networks. The shippers say, well, that would really sort of keep railroads honest in terms of quoting competing rates and really enhance competition in an industry where there's not sufficient competition. The railroads would say that it would not, that it would impair their ability to invest in the network, impair the incentive to invest in the network if they're just going to have, if a competitor is just going to quote a rate over their track. And so, in that report, Jason Seidel goes on to describe the headline risk that would lead to multiple contraction in terms of the stock price going down. So not necessarily having a hit to the earnings or cash flow right away, but how much Wall Street is willing to pay for $1 of earnings. So we'd expect those price to earnings multiples to compress, which I think that makes sense. He says it would maybe start to hit financials in about 2025. And you do wonder, is it going to be a situation where you see a lot of freight moving from one railroad to another, or is it just going to be that the threat of having this reciprocal switching as an option for shippers is going to be something that keeps the railroads more honest in terms of quoting rates? But in any event, I mean, this is something that we've heard time and time again. We've had a number of railroad shipping groups come on this show and other FreightWaves shows, and that's what we hear is sort of the one thing on their wish list that they would like to see is they would like to see the Surface Transportation Board approve the reciprocal switching requirement in the railroad industry. So that's something that I think could potentially be the biggest railroad event of 2023. A couple other bullet points here is Jason Seidel of Cowen estimates there could be a 5 to 10% average impact on rail pricing for approximately 1/3 of carloads on CSX and Norfolk Southern. Says it's maybe a greater impact for CSX and Norfolk Southern because there's more overlap between the networks. Thinks there's about 1/3 overlap between CSX and Norfolk Southern, and maybe about 1/5 overlap between BNSF and Union Pacific. Out west, some of the industries where it could be more heavily impacted, you would think would be the ones that are just really not modally competitive. So you think about things like big chemical companies that really have no option but to use the railroad, or agriculture companies, coal companies. I think the big bulk commodities are going to be ones that are most likely to be impacted. Seidel of Cowen also says he doesn't think the Railway Safety Act is going to have a major impact on the railroads. He thinks the additional CapEx spent for things like hot box detectors is going to be pretty negligible when you sort of put that in the context of the multi-billion-dollar capital envelope that the railroads each have. So I wanted to highlight those things. I thought that was a good report, both by Jason and then a summary that Joanna put together. So with about the last 10 minutes here, I'm going to go through a few different charts in FreightWaves SONAR. And if there's sort of one headline here, I'd say that SONAR data suggests that plenty of intermodal capacity remains. And I think that's particularly true on the domestic intermodal side. We heard in middle of April, some of the domestic intermodal companies like J.B. Hunt came out and said, well, there's about 15% excess capacity. And what we're looking at here is our O-Rail data, which is containerized intermodal data, and we're going to limit that data set to only 53-foot containers that are loaded. And so we're strictly looking at the domestic intermodal side of the business here. So that's the side of the business that J.B. Hunt, Hub Group, Schneider, Knight Swift all compete in. And you see that white line is 2023, and you see the horizontal lines. What I'm doing there is taking an average of the first quarter and then take another average of the second quarter. And it's only up about 1% from the first quarter to the second quarter, which a little bit less than what you might expect to see seasonally. And when you put that on a year-over-year basis, domestic intermodal volume down about 5.5% in the second quarter, year-over-year. So if I was a stock analyst, if I was still a stock analyst, like I used to be, and I was following, JB Hunt or Hub Group, that's kind of my bogey. Is I'm thinking, I would have my model pretty close to down 5.5% in terms of volume for the second quarter, which is not as severe of a decline as what you're seeing in that weekly AAR data from the Association of American Railroads that comes out every Wednesday. And the difference is that AAR data conflates domestic and international, whereas those companies like JB Hunt, Hub Group, Schneider, they compete in that domestic segment. So domestic segment holding up a little bit better, but still, if it's only up 1% from the first quarter to the second quarter, and we knew there was about 15% excess capacity in the first quarter, there's still plenty of excess capacity in domestic intermodal business in the second quarter. I think the good news is that rail service is improving. There's some shippers that we talk to on a regular basis that are customers of the data side of the house. And we heard from a major CPG company the other day is that they're using more intermodal, whereas they were using truckload the past couple quarters. And their reason for that was that intermodal service has improved to sort of that critical level where they can, again, use intermodal and not be too concerned about having those products on shelves. There was also an interesting comment from JB Hunt the other day at an investor conference where they said that the Eastern railroads, CSX, Norfolk Southern, those railroads, they've seen a significant improvement in service. And they've said on the Western side, they use BNSF strictly. And they said that, their service has improved, but it's really not yet at targeted levels. I'll turn over to international segment with this next SONAR chart. And that one is showing a more severe decline on a year-over-year basis. That's down 10.4% on a year-over-year basis, but it's up more than domestic intermodal on a sequential basis from the first quarter to the second quarter. From the first quarter to the second quarter, international intermodal up 6%, quarter over quarter. And that's really due to seasonality. So I do have those horizontal lines showing the increase from the first quarter to the second quarter in 2023 in white, and from 2022 in yellow, and then in 2021 in green. And you always sort of see that sequential increase. International intermodal is more impacted than domestic intermodal is by the Chinese New Year, which takes place usually in February, has a bigger impact on the international side of things. And so it does sort of reflect what's happening in the import market. Import volume is still down significantly year over year in the West Coast, but rising from earlier this year for a few different factors. One of those is just sort of typical seasonality. Another is the water issues on the Panama Canal. Another issue is sort of finally getting through some of the negotiations. And I think shippers are starting to get a little bit more confident that we're not going to have a labor situation on the West Coast ports, at least that agreement needs to be ratified by the port workers, but it seems to be on the right track there. You are seeing less transloading from international containers into domestic containers because there's a greater availability of international containers. And so the container ship lines, those ocean carriers, are more willing to send containers all the way from LA to points inland like Chicago, Dallas, Atlanta, et cetera. So seeing a little bit more improvement on international on a sequential basis. I'll walk through a couple more here. We have a chart on intermodal spot rates that not a lot is happening in this chart, but I do think there's sort of information in this data. And so what this shows is this is an average of about 100 lanes that we have intermodal spot rates for. And when there's any type of tightness in a particular lane, what you'll see is the Class 1 railroads increase the spot rates in order to protect capacity for the big contracted shippers. And as you can see, 2023, that white line has just sort of been on a downward slope, and really it's been sort of going down ever since the middle part of last year, 2022, in blue. I think it gave us an early indicator last year that there was not going to be a true intermodal peak season last fall like you saw the previous 2 years. And no reason to think there's going to be any capacity tightness later in this year either, with volumes where they are and with some of the domestic intermodal companies taking delivery of incremental containers earlier this year. And so if I'm a shipper and I look at that, my thought process is, well, the railroads are not concerned about securing capacity for the contracted shipper. If I'm a contractual shipper, I shouldn't be too concerned either. I'll move on to the next chart, which is really the last one I want to talk about here, which is intermodal contract rates. And this is from a company that processes transactions. And these rates exclude fuel surcharges. So it eliminates that sort of pocket of volatility that we've seen really the past few years. And what this shows, sort of taking a step back to 2020 in orange, the market started to tighten up in the middle part of 2020 for intermodal. So it moved after these markets moved for truckload. And, really what happens in intermodal is contract rates tend to respond to whether or not there was a significant peak season the prior fall. In 2020, there was. And so that led to double-digit rate increases in 2021 from 2020. And then again, a similar thing happened in 2022. And so you basically had 2 consecutive years of double-digit intermodal contract rate increases from 2020 to 2021, and then from 2022, and now into 2023. After sort of a lack of a peak season last fall, those rates have come down, and you see from that chart, they're sort of in line with 2021 levels. I would say that that degree of change is probably going to be a little bit more severe than what we're going to hear from the likes of J.B. Hunt, Hub Group, Schneider when they report earnings in a couple of weeks, in 2 to 3 weeks. And the reason for that is I think most of the lanes that go into this data set are the ones that are very highly competitive between the truckload and intermodal segments. And so I get the sense that there's a lot of auto parts in this data set, a lot of parts moving between, let's say, Chicago and Atlanta, just very competitive between truckload and intermodal. There was an interesting comment by J.B. Hunt at an investor conference recently where they said, well, some of their contracts have not yet rolled over for this new environment of softer intermodal rates. And so investors should expect another step down in terms of intermodal rates in the third quarter from the second quarter, and would suggest that the data is telling us the same thing there. So probably not something that's unexpected, but I would expect more pricing pressure in intermodal for the remainder of this year, given the excess capacity, really across modes right now in the freight space. We'll see how long this lasts. I think usually you get into an election year next year, and it tends to be a little bit stronger economically. Maybe some government spending to make the politicians in power look a little bit better. So maybe 2024 will be a better year for the freight markets. I think a lot of our viewership would appreciate that. So last thing I'll mention here again is join us July 13th. We'll have Chuck Baker on, who's the president of the American Short Line and Regional Railroad Association. And so, really think that'll augment what we've talked about here in recent episodes of People Speaking Rail, where we've talked to organization that represents the carriers. We've talked to some organizations that represent shippers. We've talked to some third parties that do, data and things that are essentially suppliers to the railroad industry. But it'll be great to get the short line railroads perspective. I mean, some of the things I want to know about is sort of how they would expect things like reciprocal switching and a streamlined a process to contest rate cases. How would that impact the short line railroads? How does the weak truckload market impact short line railroads? I think there's a lot to go over there. So I hope you can join us for that. And if you want to stay tuned to all the railroad news, one of the very many newsletters that we have a railroad newsletter, which if you just want the railroad news, you can go to www.freightwaves.com/subscribe, and you can go under classics, which is essentially for the original newsletters, and you can click on the rail, or you can subscribe to all 20 of them. And that's really what I wanted to go over today. Hope everyone has a great day.